Hi, this is P.R. Sundar. Welcome to this special episode where I'm going to talk about the true story of one of my friends and how these traders are being wiped out from the markets due to the recent SEBI regulations. Actually, it was the intention of SEBI to do that. Like some government official commented, this option trading has become a national pastime, right? So this has to be stopped. Now, there are two types of people. One, people having a huge capital, maybe 500 crore, 1000 crore, right? So they have already invested in some equity shares, right? So in fact, one of my friends, another friend, he has about 100 crores, about 130 crores worth of shares. Even after the haircut, so the limit will be given to him about 100 crore. So I used to trade with 100 crore, right? And then all the people who are holding shares or mutual fund, or even FD, so they started trading in options market. So the SEBI thought, so how to put a full stop for this. So that's why they brought a rule, 50% cash component is compulsory. So my friend who is having 100 crore worth of shares, right? But he does not have another 100 crore cash. So he had to stop trading, right? Of course, there are some smart people, they know how to work around this, but let's say common man, will not know all those techniques. So that is one side of the story. So that is how the volume has come down. But then even after introducing 50% cash component, so the volume did not go down much. So the SEBI brought some new regulations, right? So one of the main changes was that, there was a 2% extreme loss margin, or you can say exposure margin, extra exposure on an expiry day. So for expiry day trade. What actually happened, the story of my friend, it's not only a story of my friend, that's a story of most of the people, among the traders. What these people do, every day they go and take a short straddle, right, on that expiry. And then what happens, so far out of the money, call and put, they buy for hedges. Mainly it is not bought for hedges, it is to reduce the margin money. The purpose is actually not to hedge the risk, you still have the risk, right? So what happened, one of my friends in the US market, right, he sold 27 I think 27, I think. Okay, let us forget about it. Let me give an Indian context. Let us say somebody sold 24,000 put and bought 23,000 put for hedging. The market come and close exactly at 23,000. So that hedge is of no use. You will still lose 1,000 rupees. Plus you will also lose the money in hedging. Most of the people think, buying a far out of the money call and put is a hedging. That is actually not the hedging, right? So they do it only to reduce the margin money. And then what happens, they put stop loss for both the sides. As I told you, the far out of the money call and put buying is not a real hedge. So you have to maintain a stop loss. So just to give an example, the people sell at the money short straddle, now roughly about margin money is about 80,000 rupees, right? That is without hedging. With hedging, the margin money may be lower. So with hedging, margin money may be about 40,000, right? So what they do, they put a stop loss, right? Maybe because they do not want to lose more than 1% of the capital per day. For 40,000 margin money, 400 rupees, that's about 15 rupees stop loss. I'm giving the example of Nifty, but most of the people do it in Bank Nifty. So in case market move violently on one side, let us say market move violently on the higher side, the call stop loss will be hit. the put stop loss, they will revise it to the cost so that they will not lose more than 1% in that day, right? So in case if market continue to trend higher, on the upside you lost only 15-20 rupees, but put side profit will be more than that. So there are three scenarios. The scenario one, market goes sideways, both call and put will give some profit. The scenario two, market is trending in one direction. The trending direction stop loss will be hit, but other side you will get more profit. So sideways also you make profit, trending also you make profit. When there will be a problem, market trend on the higher side, call stop loss hit, then reverses and trend on the downside, then put stop loss hit. So that is when you lose 1% of your capital. What happened? Somebody tested the system. The system was working very well. And from 2018 onwards, I can say these people are making, almost 50-60% return per annum on a consistent basis. So everybody has become complacent, right? Some people even started creating some bots or algos, the ready-made algos. You just go and click a button, the computer will take care of everything. So that will sell the call option and put option at 920. Then, that will put the stop loss. If the one side stop loss hit, automatically the other side stop loss will be revised to the cost. Everything the computer will take. They charge about 2,500, 3,000 rupees. So they started doing, and then everybody started doing, right? One of my friends was trading with a big capital, right? So he thought, for the last 5 to 6 years, we have been making very good profit, and how to make even more profit, Okay. So on one side, so the trader, he has been successfully trading for last 5-6 years. Now he wanted to increase the profit. He was thinking how he can increase the profit. That's on one side. Another side, just now I told you, my another friend who has got shares worth over 100 crore, right? So there are people who have, shares worth 500 crore, 1000 crore, they are not traders. They just do not want to trade, right? But their limit is so high. Assume that somebody is having 500 crore worth of shares and 500 crores worth of FD. So that means, he meets the SEBI regulation. He has got a limit of 1000 crore. 1% trading for 1000 crore is also very, very difficult. Moreover, he is an ultra HNI client. He is not worried. So what he does, he come out with a proposal. Okay, what usually they call it as a prop test. Okay, they look at the trader. Hey, you trader, okay, if you have got 1 crore capital, let us say for example, if you have got 1 crore capital, right? So you just give me 1 crore. I will give my account with 5 crore limit. So that means your money is only 1 crore. So I'm giving you 5 crore. So that means 4 crore I'm giving from my pocket. So for that 4 crore, you have to pay me the interest. So what happens normally, so these people also, they don't give the hard cash. They put the money in FD, they pass it on to the exchange, right? So from the FD, they get about 7%. On top of which, they charge about anywhere from 9 to 12% from the traders. So that means they are getting 16-20% internal rate of return without any risk. If somebody is having 1000 crore, even if they are getting 16-17%, return also, that's about 150-160 crore per annum. It's a very big money, right? So, so what happened to my friend? He thought, why, if I'm having 1 crore, why I'm trading with only 1 crore capital? Because this system is working so well. It's giving almost 50%, 60% return per annum. So if I go to this person, if I take a leverage 5 times, if I give 1 crore, then it becomes 5 crore, right? So that extra 4 crore also I'll be making 50% return, but I may have to pay only about 10% or 15% interest to the broker. So that means I get extra 35% return. So for my 1 crore, I'm getting 50% return. For extra 4 crore, 35%. That means, 35 into 4 is 140. So that means my internal rate of return works out to be more than 100. So with this idea, what my friend did, actually approached one prop desk. Okay, I think he started trading. Although I don't have the complete detail, because no, although it's my friend, it will not be nice to ask questions, he may not reveal all the truth, but this is my understanding. And because he suddenly stopped trading, with the current broker, he changed the broker, so all those things happen. So what happened, so this particular year, as long as he was trading with 1 crore capital, he was making good profit. When he moved to the prop desk, when he started trading with 5 crore, everything has gone wrong. Right? Number one, the markets have been too volatile. From this financial year, from April 1, the markets have been very, very volatile. It goes up, comes down, goes up, So making these intraday trades very, very difficult. That's number one. Number two, with the recent changes from SEBI, although apparently it looks like, they're increasing the margin only by 2%. Okay, I will show you in the computer how that 2% affects, right? So, okay. So look at this. This is a Zerodha website. Okay. So if let us say for this monthly expiry, if somebody is selling a 23,600 call and 23,600 put, that is at the money. Okay. For the hedging, by about 600 point up and down by the hedges. Okay, you can see this span margin, exposure margin, premium received, and total margin. Okay, now let me tell you the basics. When you take a position in futures and options, you pay two types of margin. One is called span margin, other one is called exposure margin. Look here, span margin is only about 15,000, but exposure margin is about 25,000. Right? Actually, in terms of percentage, span margin percentage is higher. I think it's about 8% or something like that. But exposure margin is only 2%. Right? How come 8% span margin is so low, 2% exposure margin is so high? So that is because, okay, I'll show you, I will remove the hedges. 23,000 put, before 200 call, I remove the hedges. Now you can see span margin is 54,000. So that is the actual span margin. So span margin is, you see, more than double. I think it's 5%, I think, right? So if this is 2%, so this should be around 5%. 5% span margin and 2% exposure. Exposure margin, I'm 100% sure, but span margin, I'm not really very clear exactly. Okay, now what has happened? So in India, okay, all over the world, they charge only the span margin, they don't charge exposure. So in India, they charge both span margin and exposure margin. That's number one. Number two, how the span margin is calculated. Now, the span margin is maybe 5% of the contract value. So what is the contract value? If you look at 23,600, where Nifty is trading into 25. So that value is around 5.9 lakhs. Okay, let us say 6 lakh rupees. Okay, but here the margin is 54,744. This includes the premium, so you have to minus the premium, 9138. So your actual margin is about 45,000, right? So 45,000 divided by 6 lakh rupees. Yeah, I think it's 8%, correct. So span margin is 8%, exposure margin is 2%. Now we get the correct figure. Right. Now what happens, if you take a naked position, you are selling both call and put, the span margin is 8%, exposure margin is 2%. However, if you buy some hedges, let us say 24,200 call option you buy, that means you are hedging on only one side, or you are hedging only on the call side, but the margin will not reduce. Span margin will still be the same, 54,000, maybe slightly less. That's because the premium extra, pay. But you see the magic. Go and buy the hedges on the downside, both sides. Okay, 23,000 put. Now you watch the span margin. Once you add this, okay, your span margin drastically reduces from 54,000 to 15,000. So that's because the span margin, how it is calculated, maximum loss in a position. What is your maximum loss? Okay, or 8%. So whichever is lower. Okay, 8% or maximum loss, whichever is lower. Okay, now here you see you are selling a put at 23,600, buying a put at 23,000. So that means the maximum loss is only 600 rupees. Call side also 600 rupees. So maximum loss is 600 rupees. So if your maximum loss is 600 rupees into 25, so that's about 15,000. Okay, so that's what you see. You are saying around 15,000. Why it is slightly less than 15,000? Because when you are selling, your maximum loss is actually not 600 because you are collecting some premium. So that has to be taken into account. Okay, so your actual maximum loss is slightly less than 15,000. So the span margin is equal to your maximum risk or 8%, because if you without hedging, if you take your maximum loss, Nifty can go to 0, Nifty can go to 1 lakh, right? So that argument is there. So therefore they mean 8%. Okay, so this is how the margin is charged. So if anybody doing a straddle with both the sides hedges, the span margin is 15,000, exposure margin is 25,000. So the total is roughly about 40,000. Okay. Now what has actually happened with the new SEBI regulation, they increase this exposure margin, or what they call this extreme loss margin, is equal to the exposure margin. Whether you do hedging or don't do hedging, that will affect only the span margin. Exposure margin everybody has to pay. Extreme loss margin on an expiry day also everybody has to pay. So that means earlier the traders were paying only about 40,000 rupees, 15,000 span and 25,000 exposure. Now what happened? 15,000 span, 25,000 exposure, 25,000 extreme loss margin. So that means in place of 40,000 they pay 65,000. So that means what is happening? Your margin money payment is almost double. Okay, right. Now I told you the traders, trade in the prop desk or they take a loan from somebody. So earlier, if they are paying interest for 40,000, now they have to pay interest for 65,000. So that means their interest component has already almost doubled, right? But your return is going to be the same, right? So let us say you buy something for 100 rupees, sell for 110 rupees, you make 10 rupees profit. To do this business, if you are paying 3 rupees interest to the bank, now the bank is asking for 6% interest. So that means, your profit has gone down so much. So this is one major problem that the traders were facing. One thing is that already the markets were volatile, so many times stop losses hit. That was one problem. Second problem, their interest outgo has almost doubled. Now, that is also not an issue. Now come to the third major issue. What happens? People who are selling straddle, call option and put option. Okay, what they do, far out of the money, they go and buy the hedges, right? So typically far out of the money, so where it is trading around 10 rupees. Okay, so they'll go and buy the hedges. Now, when the traders are going and buying the hedges far out of the money, who are those people who are selling at the far out of the money? Right? So they are, some HNI clients, who want to make some safe profit. So far out of the money, they go and sell options. So these traders, they buy that option. Now what happened? Those HNI clients who are selling far out of the money options for some small money, earlier they were paying only about 40,000 margin money. Now they are paying 65,000 as the margin money, right? So their investment almost double. So because of that, earlier if they are selling the hedges for 10 rupees, now they are asking for 20 rupees. So that is why the far out of the money, trading at a crazy prices, because these HNI clients, they do not want to come and sell because, it doesn't make sense because they are asking for double the capital. They are already working, 5 rupees, 10 rupees, they are working annually, they expect a return of about 8 to 10%. So if they are getting bank FD 7%, another 7% if they are getting from stock market, they are happy with 14%. Now because, because of this extreme large margin, so capital is doubled. So that means it doesn't make sense. So many of them, they stop trading. So those who are trading are asking for sky high prices. I think day before yesterday, I remember I said, Bank Nifty has actually fallen 800 points. Bank Nifty has fallen 800 points. The Bank Nifty falling 800 points, what should happen to the call option? Call option premium should come down. But on the contrary, 56,000 call option. The Bank Nifty all-time high is 54,300. Okay, markets are crashing, and the Bank Nifty is trading around 52,500. Right, 4,000 point away. Just 3 or 4 trading sessions. Every day the Bank Nifty has to shoot up more than 1,000 points. Then only they can reach 56,000. That 56,000 call premium, going from 20 rupees to 25 rupees. Bank Nifty crashing 800 points, but the call premiums are shooting up. Why? Because when the market is crashing, people are selling call options. The people who are selling the call option nearer, they want to buy for the hedges far out of the money. So that far out of the money, all those HNI clients who have been trading in far out of the money, most of them have gone out of the market. So because of that, buying the hedges becomes so expensive. What happened last Thursday? Last Wednesday, Nifty was trading around 24,200. Last Wednesday. For Thursday, just next day, 1 day expiry. Next day, 25,000 call, which is about 800 points away. Around 325, 326 closing time. That was trading around 8 rupees. Just tomorrow expiry, just 1 day expiry, they are asking so high. Remember this whole month high was 24,850. Only one trading session, 800 point away. They are demanding, very high. Why? Because if they sell at a lower price, tomorrow morning their margin will shoot up. So for them, so they have to set aside, at least 50% extra capital. So you sell for 2-3 rupees, the return does not justify. So what has happened? So these people, okay, number one, the traders, they go to prop desk, okay, they take a loan, so they pay the interest for the loan. And second thing, they buy the hedges both the sides, so that most of the time that hedging money will be gone waste, right? As I told you, that's not going to give a real protection. As I told you, where 3 days, the 3,000 point in Bank Nifty on the higher side, they're not going to happen. But earlier, if they're spending for 10 rupees for hedges, now they're spending 20 rupees. So that means, so this will cost extra. So to put it very simply, earlier, okay, if I'm paying 10 rupees interest or 10 rupees for hedging, so 20 rupees is gone. Okay, so if I make 30 rupees profit, even 20 rupees is gone, I still make 10 rupees profit. Now what has happened, my interest has gone from 10 rupees to 20 rupees. My hedging cost has become 10 rupees to 20 rupees. So that means it has become total 40 rupees. If I make 30 rupees, when my expenses are 40 rupees, effectively I'm losing 10%, 10 rupees. So, this is how, you can see many people. If you follow the social media, you will know there are some people, they have publicly announced, no, I'm stopping the trade. I'm closing. So one Bangalore-based trader who used to talk a lot, so he got out of this market. He said, it's not worth the trading. It's better to look into my family business. But that guy is a very smart guy. He has taken a decision very, very early, right? So actually, he did not lose much. But those people who stayed, until now, this financial year, they made even bigger losses. So one of my known person, okay, so he almost, 75-80% of the capital has been wiped out. Okay, actually he lost only 15%. So in the beginning of the story, I told you that person, okay, for the last 5-6 years, I've been making very good profit. He shifted to prop desk. Okay, so this year his loss is only about 15-16%. But what happened, because he has taken the leverage 1:5. So his loss, for his capital, let us say 1 crore, he lost, let us say 15 lakhs. But he took another 4 crore loan. For that 4 crore also 15%, that 60 lakh is also gone. So 15 lakh from his own capital, 60 lakh from borrowed capital. So 75 lakh is the loss. Your capital is 1 crore, you lost 75 lakhs. In addition to this, for that 4 crore, you have to pay interest to the broker. So that means what? So your capital is almost wiped out. Okay. So this is how this intraday traders, has been killed by the exchanges. All right. On top of which, if you make some profit, okay, this STT has gone up by 4-5 times in the last 5-6 years for options trading. So you pay STT, stamp duty, brokerage, irrespective of whether you make profit or loss, you pay all these things, right? And then on top of which you make some money, 1/3 of that will go into taxes. So effectively you don't get much, right? So that's why. So the moral of the story is that, so even if you are an intraday trader, so better stop trading. So it is not worth trading intraday anymore in Indian stock exchanges. Right? So don't go by the social media post, right? So there may be many other things behind that. So don't believe. So my simple suggestion is that stop trading intraday. In fact, that is the objective of the government. So that is the objective of SEBI. And I heard, I do not know how far true, I heard that, the prop desks are showing 50% less volume in the last 1 month. Because, people are like, I think on December 5, something happened, very huge upside and downside move. Many people have given 1 crore capital, they trade for 5 crore, their MTM loss was more than 1 crore. So the brokers, they cut the position, so all these things has happened. So number one, the rule number one in stock market, always trade with your money. Don't ever borrow money, right? So once you lose your money for 2 days, you can't sleep. After that, the life goes on. But the borrowed money, then you have to pay interest for that. Forget about trading. Even in investment also, never borrow to invest, never borrow to trade. So that's the rule number one. And second rule is that, you can't fight with the government. Right? So the government decided, so this segment has to be brought down. So that means, they will do it. So if still the volumes are not going down, what will happen? SEBI, after 1 year, they may increase this extreme loss margin maybe from 2% to 5%. So, they can do anything. And I do not know rationally, right? Trading intraday, I agree. That's a meanness, I can say. But trading long-term options is supposed to be more safer way of trading, But still, the SEBI thought, there is a bigger risk in trading in long-term options. So they put 5% extra margin, right? So, initially, this extreme loss margin, they were, in the paper they released, they were suggesting 3%. But finally, they made it 2%. So if the volumes are not going to come down, then again, the SEBI will increase this to 5% or 10%. So that means what? No, nothing. Okay. So number one, don't borrow capital to trade. And number two, always go along with the government policy. If the government policy is to reduce the volume, better reduce the volume. You keep on increase the volume, then the government has all the powers to do anything. So that is what the SEBI has done this time. So that is what is facing, right? So let us hope, with this intraday players out, markets became more and more stable. But last 1 month activity, it was even more volatile. But luckily, the number of people affected or the impact was not very big because of this reduced volume because of this SEBI rule. So that's it for now. Hope you enjoyed watching this video. Thank you for watching.